Hi, I'm Sam Sells, and welcome to my podcast, Clean Money. I like to say investing matters, and my show is to talk with everyday folks that are not only creating great success, but making an impact in society and improving the lives of others. That is my mission, and I want to share my stories and others with you. Welcome to Clean Money. Thank you, everyone, for joining us again today for another great episode of the Clean Money Podcast, where we talk about making a difference in the world through our investments of time and resources. My guest today is Travis Baucom with Balcomie Capital. And Travis says not to look at his hair because it was riding cheap on the way here today. And man, I love it. We like to put the wild in Wild Mountain, which is my capital company. And we just like to keep things real. So Travis is the founder and CEO of Baucom Capital, a boutique firm for high net worth and high income individuals. With over 10 years of experience in real estate investing, Travis has consistently achieved average above market returns. He personally selects all key investment markets and asset classes for Baucom Capital to meet the goals of his investors. As CEO, he leads the company's overall investment strategy, asset acquisitions, and business development activities with its mission to deliver fully managed private investments that allow investors to pursue what matters most to them. I love that. Prior to Baucom Capital, he was CEO of the largest privately owned distressed house buying company in the state of Texas called Texas Trust Home Buyers. During his 5-year tenure, he successfully acquired and managed over 400 single-family homes. That's a lot. Through his leadership, he developed and implemented an effective strategy that contributed to its success. Super cool. We were just talking about this, Travis, about single-family homes versus commercial real estate and why you made the jump. So can you just tell our listeners a little bit about that transition period and how that occurred?
Yeah. So, when you grow from 2012 to 2018, you buy that many houses and you trying to rent out as many of them as you can. You end up just takes away more cash than you expected. And so on top of that, like you have issues with liquidity, even when you're making a good return, having issues with cash flow. When you have so many houses, you have I think we get up to 103 rentals. You have 103 chances of an HVAC unit going out that month. And so, and most of the time it was a good 10% chance because tenants never replaced the filter. It's super hot in Texas. And these are pretty low income. Like we would go into Class C markets and try to make the Class B product. And we realized the reason why that is a Class C market is because no one wants to take care of their house. And so, so mostly those Class B houses ended up being like Class C or just completely worse than that. And so, pretty rough experience. So 2018, October 2018, my operator came to me and he's like, we need 150 grand to make it for the next 6 weeks. I was like, well, 6 weeks isn't that long of a time. That's a lot of money. And so, and so I ended up, I go, okay, well, I'll go get the money. I'll go get lunch with the guy to get the money. What I need you to do is to take your lunch hour and figure out how we're going to pay that money back within the next 90 days, because we can do that. That's not a problem. And then we had done that in the past. And, essentially what I would realize when he asked that is like the disposition side was completely messed up. Like they were not clearing out houses fast enough. The construction guy wasn't getting deals, getting the properties like finished. Then the disposition person was not selling them fast enough. And so that's where we basically had a bottleneck or constipation or something, like whatever you want to call it. And constipation is probably the more correct term because of how painful it was. So I had lunch with a buddy of mine that had that money, and he goes, "How's your day going?" And I go, "Well, I'm firing everybody when I get back." And so because I was like, I'm so burned out of this business, I don't want to do it again. This business is supposed to serve you, and this business, I felt like I was a slave to this sucker. I would have much rather worked for 60 grand or 70 grand working for someone else, knowing that like I don't have to worry about lawsuits. I don't have to worry about property manager stealing money from me. I don't have to worry about construction costs going over, which they pretty much did on a regular basis. I didn't have to worry about satisfying my partners. Like I was so burned out of that business that I was like, I'm just shutting it down today. And so that's what I did. I came back. I was like, hey, man, what'd you come up with? He goes, well, I think we can do this. I think we can do that. I'm like, well, that's not going to work. I think we're just going to close it right down. And so so I had 5 full-time employees and 4 VAs. I ended up firing everybody. And I left the marketing numbers going and had those forwarded to my cell phone. And I took all the files and everything else back to my house. And then spent 28 months unwinding a very large rental portfolio and a whole bunch of fix and flips, 42 fix and flips that just had stalled, or that we looking at the invoices. I'm like, you gotta be kidding me. The construction manager had been paying the drywall guy the same thing every week. You're like, why are we paying drywall 3 times for a house? So
Yeah.
it was just a cluster, man. It was real bad. And so as I was winding that down, as I realized I was going to get out of it and I was going to have some cash, I was like, I'm not going back to houses. Like houses is, I know too many people that own 100, 200, 300 houses, and they're just rough looking. They're angry all the time. I don't want to be in that business anymore. Surely multifamily guys were really happy, it seemed, but I didn't want to invest in multifamily because I had bought a couple of apartments. And I was like, I really do not like people, especially lower income people who, mental health, victim mindset stuff. I don't want to deal with that. I don't want to enter that into my life. And so that's when I found storage. And I really like storage because at the time you could build a new facility for $35 a foot. And then you could rent that $35 a foot out for an average of $12 to $15 a year per square foot. And I'm like, wow, that's great, because that means like even with the 50% cost basis, I'll have my money back in 6 years. This is awesome. This is a great return. Yeah. And so we started looking at deals, just kept on getting no's, brokers laughing at us, brokers telling us to never call them again because you're asking some of the dumbest questions. And eventually we got a guy that wanted to help us, 2 brokers that wanted to help us. And I'm still friends with one of those brokers. The other one, I lost contact with him, but both of those guys still ended up selling us our first few facilities, and independently of each other. And man, like 6 weeks after owning them, I was like, this is awesome. Like the biggest issue we had is someone wanted her $20 rental deposit back. And like my manager was like, I don't think she deserves it. Stuff like that. $20. And I was like, well, just give it back to her this one time and tell her thank you for using, A+ storage. That's something. Coleman Storage was the facility that one was at. But yeah, that's the real short end version of the transition. But man, I haven't regretted it. If the recession happens, we might buy some houses, but more than likely, we're just going to find a commercial asset that is distressed and just buy that. People create chaos, and when chaos is around, it affects your yield. Your maintenance is going to be too high. Your like I said before, like there's always 103 chances that something's going to go wrong with 103 houses. Well, really, when you take that, it's like 103 chances that something could go wrong. And in that chance, there's 5 or 6 things that could go wrong, because of especially Class C rental property. You could have HVAC, your electricity pole could fall down. You could have a kitchen fire, all these things I've experienced. Kitchen fire, you could have arsons living in one of your houses. You're like, what? What's going on? There's a city, and like all around my duplex, there was these arson fires. This is back in 2014. And I'm like, what in the world? I'm going to make sure my insurance is good because my house is going to burn down. Then the cops arrested my tenants because they were the ones causing all the fires. Oh. You're like, you got to be kidding me.
Terrible.
And so I am so averse from having any humans live in anything that I own because of that. And
you didn't put that on your, questionnaire. Are you an arson? If so, you cannot live here.
Yeah. Have you ever set fire to something out of aggravation that didn't need to catch on fire?
Yeah.
So man, it does. Wow. And then it's dealing with the city issue. I mean, it's rough. And so all that to say, like, I love having, with storage, it's a box, it's a ATV, it's a snowmobile, it's an RV, it's a boat. Those things do not create chaos because they take them out and they leave the facility, and then they get in, and that's when they start. It's a boat. That's when they start drinking, and there's an issue in the future, but it's on the lake as opposed to inside my facility. Right. Or if I have an issue in the facility, it's because when they came back, they having a hard time backing that boat back up into that stall. And so, it's what I've learned with storage. You have very low maintenance issues because humans aren't involved typically. And because of that, you can really project your yield way better than you can with anything else I've owned, houses, apartments, small office complexes, private schools, all those things. storage always has the most consistent yield for us.
Yeah, I love that. And it's been the same for us. So we've done storage, like I was mentioning before we went live here, and it just really surprised us at how efficient and effective the project has been. Like we had scheduled it to take 2 to 3 years to max out at 100%. We hit 100% in 6 months.
Wow.
We're like, oh wow. Where's our next where are we building? So we have some of the land, working with a guy to build there some more units, but it's like this is gravy. Now we have apartment complexes and humans for sure, and then if you really want to get crazy humans, mobile home parks is like it has the best cash flow of any asset we've had. Like a dollar per dollar yield. However, it's also
Wow.
easily the most drama. So and so's wife went over next door and got in a fight with somebody else's wife, and like fisticuffs, beating each other up.
Ouch.
Property manager getting arrested for dealing drugs, and it's just like
The property manager.
yeah,
He has a nice
like,
clientele out in the park.
like, man, he was our best collector. Like, collections just went off the chain when he was here. And you're like, oh, that's because he was a drug dealer. And you're like, oh, why don't you do your background checks? Because a lot of time background checks show nothing.
For sure.
They just
100%.
Unless they were actually charged, it's just not on their records, right? And so lots of humans. Now, for us, we're trying to impact those humans, so it still makes sense. But for some investors who have come in with us, and as they've seen some of the drama that's unfolded, kitchen fires and other things that have happened, I can tell that they would be much better suited to go invest in storage rather than apartment communities for sure. So single family homes, I share your grief, having owned single family homes and never wanting to do that again. But that's the thing that gets peddled on Americans the most, right? Is buy a single family home, buy a duplex, do the BRRRR strategy, keep doing it, do more and more and more, and eventually you'll be wealthy. And I think, yeah, like you said, eventually you might be wealthy, but you'll have no hair. You'll not like your family. They won't like you.
And like the strategy of the whole BRRRR is actually a commercial real estate strategy that has been in place forever, because in commercial real estate, as you know, like you have forced appreciation. You raise the rents and that adds value to your property. Whereas you raise rents in a house, it's still a comparable market approach. And so I think the BRRRR strategy is going to go away in the current market, because where are you buying a house at a 8 cap and then refinancing at an 8% interest rate? That's just like the DSCR is just not going to work. And so you're not going to get your money back. It's going to dry up. Short-term rentals, I feel like, are going to dry up. I really feel like I agree with you. The reason why single family homes are peddled the most is because that's how gurus make their money. Because if you're a teacher making 50 grand a year, and like he's saying, like, you can buy this house with no money down. Most of these guys are my friends that I'm talking about right now. And like, they're like, yeah. And so just pay us this weekend, come and pay us $500. We'll teach you how to buy your first house without any of your money. And that's a really appealing thing. That's actually how I started. I took an intensive course and came back, got really excited, started buying houses and realized how easy it was. And then, bought a bunch of them. And so it's a good place to start. I think it's a terrible place to try to make a career in, though. In my opinion, like when people ask me, I would say get up to like 5 or 10 houses and then sell them after a year or two and take that money and use that money as interest or earnest money and due diligence money on a commercial property, and then raise the capital through syndication. You get fees, and then you have a good amount of ownership and you manage it, and you're the operator, but you're raising, $500,000 for your first deal or $1 million for your first deal. That's not that hard of a raise. It seems daunting, but really that's like 5 calls for 100 grand.
Yeah.
And so
When I first started, it was super daunting to me, and part of that was because I was raising $20,000 a pop, and so it was like 40 investors to get a deal done. I'm like, why am I doing this?
That's painful.
Raise it to 50K a pop and saying, I mean, people still invest, and you're like, oh, why? This should be $100,000, and I just need five, and we're good. Um, when I left single family when I decided I needed to go full time. And the only way I was going to go full time was to enter commercial real estate. And
Mhm.
that made, and that was it. We went full time, and a lot of people we don't understand. I would say most Americans do not know that through syndication, you can use very little money of your own money and buy big assets. You can actually get paid to buy assets for other people. You can get paid to manage those assets from afar as an asset manager or as the operator for people. You can earn those fees. And if you do a great job, you can make a ridiculous amount of money. It's not something that's taught anywhere. It's why I started coaching people on how to do that. I've seen a lot of folks go out there and make big mistakes. And I think some of those are probably gone right now. The market is auto correcting. Um, you and I talked about this briefly before. The market in its current condition is affecting everybody. Some folks more so than other folks. You have these giant firms who are getting themselves in hot water because they got too high leverage on assets, and now they're in trouble. But we saw 3,200 units. I don't know if you saw that from Houston that came.
Yeah, the four facility $221 million. Yeah,
Yeah.
it's rough.
Yeah. It's like, I think probably $80 million of investor equity just vanished.
Ouch.
Ouch. But long story short, it's that the lessons I learned in single family in 2008 is what's enabled us to make it through, because we did a low basis back then. Flipping homes, you always had a low basis. You always wanted a low basis. And when 2008, all the high leverage people they just went BK, bankrupt immediately. Right? They had no choice. There was nothing they could do. But if you have a low basis, you can still go out there and refinance. You can still go out there and hold on, or you can hang in there because your payments are low, or the property is still tradable. You just have to sell it at a bigger discount. However that works. So, what do you think are the big lessons now for folks with the current economy and where things are going?
For people our age that are in this industry, I think this is the first time we're seeing a real recession. Like COVID was like a flash recession. Mm-hmm. Like by the time we were like, what's my name? Like it was over. Yeah. And it was because of and I felt like at the time the government did a good job with the CARES Act of getting money where it needed to be. And then administration change, another, I don't want to get political, but a lot more money started getting pushed in after the administration changed. I think that to just try to disprove what happened the year before. And because of that, that's why we're in this situation. But, and then another argument could be, hey, it was coming and COVID sped it up, and then we tried to fix it and it broke the system, and things are selling at 3.99 caps and you can get money at 2.85%. It should have never been an environment should have never happened.
Right.
And because it happened, now we're having 6.5 caps, 7 caps, 8 caps, and 8% interest rate or 9% interest rates. Like we're honestly borrowing hard money from local banks historically when it comes to an interest standpoint. And so I think what I'm learning is like no matter how good something is, you got to be really careful, because when it comes down to it, you can't control all of the moving pieces, right? Like we can't control interest rates. You can't control what the Fed's going to do. Can't control what the president's going to do, or the Treasury, or any of those. I think all of us are surprised that banks are failing. You're like, man, banks, why are they failing? They should be they've had some of the best run-ups over the last 5-10 years. But then, you find out, you get in the nitty gritty, and it's just, they were lending on some crazy stuff. And it's all Silicon Valley banks for the most part. Or so far it is. And so, for me, like I go back to my core objectives, core beliefs of like, I'm going to invest in a business first market. I'm going to invest in a population increasing market, where a market that the population is increasing. Specifically for my asset class, that's like one of the best things. When you have a ton of people moving into a market, that tends to be what really helps that asset. And then just from a personal standpoint, when COVID hit, I had very little cash reserves. I have a lot more cash reserves right now. I wish I had a crap ton more, just not because I feel like I'm going to run out, but just generally speaking, I'm like, I don't know what's going to happen here. And I just would kind of like to, be able to sleep well at night. So I think our generation of commercial real estate investors are finding out that like things do change, and how do we pivot during these changes? How do we continue to have a viable company with employees, and still serve our limited partners when we can't give them, distributions, even though the deal on paper is still worth twice as much as we paid for. We just can't, refinance at 8.5% because of debt service coverage ratio constraints.
Right.
And so a lot of that just comes down to communication. Like, this is a temporary setting. The government's trying to slow down the economy. It is starting to work. They're probably going to let it continue to. They're pressing the brakes pretty hard right now. They're going to continue to do that, and then hopefully that brake gets pushed a little bit hard, and it just happens, and other things happen where like they're like, okay, the brake's been pushed hard enough. Now we can like start easing off a little bit. We might be in an easing off period now because the Fed hasn't raised rates in the last two sessions. Banks are still failing. Banks is where liquidity comes from. If liquidity dries up, we don't have a recession, we have a depression. And because if no one can get financing for things dry up really quick, just like in 2008, 09, 10, and 11. And so,
once the credit crisis was more destructive than anything else, right? If you can't get lending, you can't exit. Like for us, we do a lot of heavy value add. And so if we're ready to exit the heavy value add, but now we can't, or in our case on one project where the lender had liquidity issues and they stopped funding the construction.
Ouch.
And we're like, I understand people are upset with me, but it's like, I literally, I cannot control the bank. That's, it is where we're at. And so now we just got to decide how we're going to fix it or how we're going to get out of there. Now, if you add that plus a lending or a credit crisis, and now you can't even exit, your options dry up. Fortunately, lenders are still out there, so we're able to refinance that project and move on with our lives. But, I know I have good friends who, building, apartment complexes or other things in 2008. And when the loans, their capital just went away for their project, and now they're supposed to be paying these massive fees and everything else. They went bankrupt in a day. In fact, I have a friend who's building a skyscraper, Can Van Loo in New York City, and his equity partner was Lehman Brothers. They had $300 million in the deal. So,
wow,
what happens if that's your partner?
Ouch.
Yeah. You're done, right?
Wow.
And before we jump on people and say, oh, they're terrible businessmen because
no way.
Yeah, you're like,
it could happen to any of us. Like, that's the thing. And I would say the people who don't think it's going to happen to them are the ones that are most vulnerable, because they're not thinking that it's going to happen to them.
Yeah, and that's exactly right. I saw a big group offering a deal, Class A, beautiful asset in Florida. And in their underwriting, we said, we're super conservative. This is February of last year. Super conservative, saying that rates could rise by 2%. And we'll still be able to make debt service. Well, rates rose by 5%.
You're right.
So I don't know if they're in default now, but a whole bunch of investors joined that deal. And these guys were savvy. They had almost $1 billion worth of assets. And here they are. It's just, we don't control the market, but we have to deal with it.
Yeah, that dealing with it is that, and I think so. Going back to the interest rate being super conservative, one, I've always can't wait till I see the offering memorandum. We're like, hey, we're really liberal on this. Like everybody says they're conservative. Like, of course you are.
Yeah, of
And I'm
course you
just
are.
like, we're just pushing the rate. We think,
Yeah.
no one does. No one really actually does that. But yeah, like on the rates, like I think everybody's pro forma didn't have a 5% jump,
Yeah, nobody.
and if you did, you're like, man, you're one of the smartest people on the planet, because like no one knew that was going to happen. I don't even think the Fed knew they were going to have to raise it as much as they did. Um, but I would say like the right now, what's going to happen in the syndicator sponsorship world is the sponsor who can navigate this well is going to be the one that gets a lot of money at the end. The one that goes, man, I'm just so stressed out. I don't want to do this anymore. I'm just going to liquidate everything. Those are the guys who limited partners realize aren't cut out for this business. Like things go up and things go down. There's peaks, there's valleys. Globally, we've been at a high peak for a very long time, and now we're coming on a valley. I hope it's a very shallow valley, but chances are it's not going to be based off of some of the data we're seeing. But ultimately, that's where like the sponsor who like our deals, and I hope it's enough. But we always, when we raise capital, we have 12 months of mortgage payments that we raise on top of everything. So we have the 25% down payment, 12 months of mortgage payments, fees on top of that, and we try to limit the fees based off of what the project is. Like if it's a development, we're going to charge higher fees. You're going to be driving up there a lot. If it's just a value add where the manager is going to do all the work, we're going to charge a lot less fees.
Yeah, smart.
But all of our facilities are still doing really well. The ones that haven't had any catastrophes happen to them from like, we had an Oklahoma City facility. There's 13 grass fires in Oklahoma City about a month ago, and one of ours got hit. So like, so we lost about 30% of that. We should get a very large check from the insurance, and it'll cover way more than what the cost is. So it'll work out in the long end of it. But all of our facilities, they're either breaking even or making money, and they still have that reserve. Our DSCR averages are well into the 1.6 to 2.0 ranges. And so we can lower our rates just to stay viable. But you're probably going to, if you're one of those people, if you're a syndicator who's like, oh, now my 90% occupancy is down to 80 or 70, if that bothers you, it might bother. It's supposed to bother you, but if you look at your cash flow, if you're still making cash, then you should be fine with it, because the reality is people are losing their jobs. They're not going to afford storage. In my instance, they may have to go from a 2-bedroom to 1-bedroom with multifamily guys. But ultimately, just having a lot of cash stacked away is going to, and making sure that you pivot really well when you need to, and not freak out about like lower occupancy or lower interest rates. Sorry, lower street rates in the storage world. Then you should be fine. But yeah, it's I think it's going to be challenging for everyone. That if this lasts longer than 2 years, then everyone is going to have an adjusted rate to deal with. No one is going to be safe from that, and that's when it's going to be interesting to see what happens.
Yeah, I think I was on the phone with another syndicator the other day, and I was asking about his project. He says, "Oh, we're okay. We're doing okay." It's like, "You guys bought a rate cap?" He said, "Yeah, we bought a rate cap, but in my opinion, they just paid way too much for the deal, so they're over leveraged. So they're kind of holding on, and they charged a ginormous fee, which they ended up not being able to pay themselves because they couldn't finish off the raise. But I'm just thinking, that cap or that rate cap probably expires in a year, because most rate caps expire. They're not like a forever rate cap. It's a 1, 2, 3 year rate cap. And if we're in a bad spot rate wise for another couple of years, because on one hand, the Fed is pumping more money into the economy, and on the other hand, they're raising interest rates. We call that what did you say? A spiral of death earlier, right?
Downward spiral of death. Yes.
Yeah. Downward spiral of death. So we're just in this, self-created downward spiral of death. He's going to be in a world of hurt. We all are. We all are going to be in a world of hurt in some form or fashion, unless we have a lot of cash on hand.
Yeah. And I don't, and the thing about cash on hand, like we've got about 10% of our debt in cash right now. Mm-hmm. And that's probably a lot more than most syndicators, but I don't know if it's enough.
Yeah.
So, like, I think it's enough, but I don't know. Like this, it's all like, you get asked questions about, your limited partners ask you questions. You say stuff like, this is where we're at, and this is what we're planning on doing. This is how we're pivoting for this. And that's, that's as good, like every syndicator is saying that, every publicly traded company is saying that right now.
Yeah.
It's such a unique market, because you have companies like in 2008, everyone was losing money. Everyone was getting hemorrhaged. Right now, like quarterly reports are coming out, and like companies are making money, but the commercial real estate, loans are, everyone's saying there's a, ghost default rate out there, stuff that's already kind of defaulting, but it hasn't been made public. And so, but I honestly think it'll be shopping centers, malls, offices, and strip malls, stuff that was like retail consumer that Amazon's basically taken you out already, or like work from home. Like, my assistant doesn't live. That's not what I meant to say. My assistant's not here. She's in a different city.
Yeah.
And that's, super large mega corporations are doing the same thing that I'm doing. And that's going to be painful for office complex owners.
Yeah, so. It is. We went totally virtual January this year. Like, we have nobody in the office anymore. So we shuttered our office, or broke our lease, and moved on. It's going to be an interesting year this year. It's going to continue to be interesting next couple of years to see how things turn out. I know we are fighting tooth and nail to make sure that all of our projects are prepared and safe, and refinancing everything into long-term debt, while refinancing is still a possibility. Assuming we don't go into a credit crisis, if banks keep failing, we will have a credit crisis, and then it'll just make things worse. Travis, thank you so much for joining the call today. And how, for those who are out there who are interested in investing in storage, which I highly recommend as a great place to go put your money, it is without a doubt commercial real estate's most safe investment. And it has been proven that over and over again over the years, with the lowest default rates of any loans, which you already know this, Travis, but I don't know that our listeners know this. So how can they find you? Where can they go to reach you?
Yeah, well, to hit on that real quick, a 40-year default rate is less than 1% on self-storage facilities. So the best way is go to investinstoragedeals.com. Scroll to the bottom and fill out that information, and you'll start getting our deals. If you want to reach out to me and have questions directly, you can get on Instagram and search for Travis_Baucom. It's BAUCOM. And that's pretty much where I hang out at. So
awesome. Thank you, Travis. This has been a very good conversation. Storage I love storage. So, and I love the impact you're having on people, helping them find a good, safe place to store their cash, and not have to deal with tenants, townships, toilets, crazy humans that we all are sometimes. And I wish you all the best. Thank you for being on the show.
Yeah, appreciate it, Sam. Take care.
Thank you for tuning in to Clean Money, where we talk about sustainable investing that improves society. We are passionate about creating great investment returns to investors who want to use their money to make a positive social impact in the world. If you enjoyed the episode, we'd appreciate a 5-star review. And if you are interested in making your investing matter, please connect with us at wildmountaincapital.com, or you can find me, Samuel Sells, on LinkedIn, on Twitter at Sells_Samuel, on Instagram at Clean Money Sam, or on Facebook. And finally, make your investing matter.